Hi, Oliver. So we're here today to talk about small caps. Traditionally, small caps have outperformed large caps, but how are they done this year?
Well, in 2014, there wasn't such a big outperformance as there's been previously. As you say, traditionally, small caps have outperformed. And we've had the publication this morning of the Numis Smaller Companies Index. This is an index that goes back 60 years. It's got 60 years worth of data and looking at underperformance. And in that context, 2014 wasn't a great year for small caps in terms of outperformance. A pretty flat performance, but over the longer term, the data shows that they still outperform quite a lot.
And what about the AIM index? The AIM index, I think, produced a loss last year of 17% on total returns.
It did, yes. So AIM is the smaller companies market in the UK, and there's a difference. The Numis index I talked about earlier is the bottom 10% of companies on the main market. AIM is a separate market and has its own collection of 1,000 or so companies. Now, given that the companies of these two different indices are broadly of similar size, although slightly smaller on AIM, you might expect a similar performance. That's not the case. AIM has underperformed, and that's been the case in several years. And it's very easy to see that there's been some big blow-ups on AIM. Quindel is a very well-known one. This is a legal service business that lost its chairman during the year. So there's been a lot of disasters, but then by the same token, AIM has had a lot of very sharp share price rises, but added all together, and AIM has still underperformed the smaller companies on the main market. There's lots of possible reasons for that. One that was very prominent last year would have been the fall in value of commodities and hence commodity-related stocks. A lot of companies on AIM are either in the oil and gas sectors or in the mining sector, and so they were hurt a lot by the fall in commodities prices. That explains some, but by no means all, of AIM's underperformance last year.
I think if you removed the resource index, the resources from the index, it brought it up to about -7%, I think.
Yeah, so still an underperformance,
yeah,
but not quite such a big one.
Definitely. And small companies generally have outperformed, from what Numis said today, over the past 60 years. They found on average, I think it was about 3.4% that they'd outperformed the large ones. And they also found that sort of traditionally across global indexes. So when they compared the small indexes for the MSCIs to the large indexes, over 80% of the countries, they found that small caps outperformed large. I mean, is this something we're going to see going forward?
Yeah, the small cap premium's been there for a while. The thing is, small caps are riskier, and as ever in the stock market, there's a balance between risk and return. Small caps are riskier. They either come with they're either technology companies, and there's a big risk that their fantastic new gizmo won't actually make it, or they're very concentrated in a particular sector or a particular geographic market. So they are riskier companies, and for that risk, you should expect more of a reward for investing in them. And that's demonstrated by the fact that there have been such huge blow-ups in small companies, but also some huge successes. But what's interesting about the data, I think, is that it shows over the long term you can outperform by investing across the board in small companies.
Everybody sort of goes in hoping that maybe they're investing in the next Apple in somebody's garage.
Somebody will, but most won't, I think.
Yeah, definitely. Thanks very much.